quite clearly, habits have developed somewhat going into this shutdown. How sticky have those consumer habits been coming out the other side?
Yeah, good morning. It's a great question that you asked. You know, we're still seeing quite a bit of volatility out there. If you look at the quarter that we just went through, we started very strongly. Then when went into lockdown, the beverage business clearly softened up. Then as we exited the quarter, the beverage business really started to strengthen again. So you do see a portfolio that works in this environment. When people are more in lockdown, the snacks and food business tends to do better. As mobility increases, you do tend to see the beverage business pick up a little bit. In terms of stickiness of habits, I think there are a couple notable trends with consumers. Number one, there's been a reversion to big trusted brands. That was something that obviously people were moving towards smaller brands pre the pandemic, but they really do have a lot of trust in big brands. And I think that's likely to sustain because as they've come back to big brands, they've really liked what they've found. Number two, the notion of eating at home, particularly breakfast at home, I think is going to be a habit that will stick for a period of time. So obviously that benefits our Quaker business quite a bit. And number three, snacking really tends to do well regardless of the environment. People just adjust their habits to in-home consumption versus out-of-home consumption. So the snack business tends to power through these types of issues more than anything. So overall, we feel like we had a pretty good quarter.
Hugh, you've talked about the volume there. You've also touched on market share. The consumers are going towards the reliable, big, well-known brands. Can you tap into where you've been building market share and where you're more constructive in the year to come on that front as well?
We have, and actually we've been investing in building market share, not by taking price down because we want to build sustainable market share. We're rather focused on innovation as a mechanism to drive market share. We're focused on moving into new adjacent spaces like our acquisition of Rockstar Energy and now upcoming our launch of Cheetos mac and cheese. So we're pulling the innovation levers, we're pulling execution levers, we're ensuring that we support the brands properly. And we've seen pretty good market share gains in the snack business really all over the globe. In the beverage business, the market share situation has been improving, and in about half of our markets, we're holding and gaining share.
Hugh, the away-from-home channel just looks absolutely dreadful right now. We're looking across the restaurant business worldwide and really struggling to see how we normalize anytime soon. From your perspective in the C-suite right now, when do you look around and just think, you know what, things aren't returning to normal anytime soon. Let's pare back the cost there. Let's pare back on the investment.
Well, we do think eventually restaurants will come back as a channel. Clearly right now that's down and down significantly. But even convenience stores, which a couple of months ago were negative, have now turned into positive territory. One of the better moves that we've made in the recent past was actually to build out an e-commerce business relatively early. We started investing in that in 2015. And now e-commerce is going to be about $3 billion for us in retail sales. We wouldn't have been able to do that had we not invested in e-commerce in the past. So we'll continue to build out all the channels.
I want to talk about how you're running the business as well, how you operate at full capacity with social distancing constraints. I can tell you, Hugh, for me, trying to operate this program, the guests aren't around the table with me anymore. The reporters aren't next to me anymore. Things have changed, and they're going to be this way for a long, long time. I just wonder from your perspective, as you look through your business, how you've been able to operate anywhere near full capacity with these new constraints.
Yeah, I mean, our first priority, obviously, is to protect our employees. And that's something we've spent a considerable amount of money on with personal protective equipment and sanitation and things like that. The reality is social distancing doesn't present as big a problem for us. Our plants tend to be reasonably spread out in terms of the employee density. We have, obviously, lots of salesmen out in the marketplace, and they tend to be spread out. What we're doing is everything we can to make sure that our employees stay safe while they're doing their jobs. In the second quarter, as Scarlett noted, we spent about $400 million in COVID-related costs. Now, some of that will diminish over time as we get more efficient with it, but it's something that's a clear priority for us, and we figured out how to do it reasonably well. One other move we have made is we have reduced the complexity of our portfolio. We've taken our SKU count down by about 15%. And we've learned from that. I expect we'll probably stay down about 5 to 10% on a permanent basis.
Are you running higher inventories as well, Hugh? Is that something that's changed coming out the other side of this?
We are. We've made a decision that we need to do that because of the unpredictability in terms of where the infection rates are going to be. And our first priority after our employees is to ensure that our customers are well serviced. And carrying higher inventory levels does allow us to do that.
Hugh, you've got to help manage the debt profile of Pepsico as well. I was looking at the borrowing costs in the secondary market for 10-year paper now, in at around 1.3%. When you issued 30-year paper back in March, the spread over treasuries has basically halved over the last several months. What does that mean for a CFO right now as you look at your borrowing costs come all the way in the last several months?
Yeah, we've been actually pretty good about extending the maturity of our debt portfolio overall, so that we manage refinancing risk down well. We basically carry zero net floating debt right now. We're essentially 100% net fixed. And over the last several years, we've moved from an average maturity of 4 years to 12. So by virtue of doing that, we provided ourselves a good insurance policy, taking advantage of the low rate environment that we've seen over the last couple of years. And inevitably, when rates return to more historical norms, Pepsico will be relatively well insulated on that front.
Hugh, that's the debt profile. I just wonder if it incentivizes investment at this point when you can borrow so cheaply. Is it still too early to make those long-term decisions, to make acquisitions in an environment like the one we're in right now?
Well, we actually have been reasonably active on the acquisition front. Over the last 2 or so years, we've spent about $10 billion on acquisitions to buy SodaStream, which is a terrific product, environmentally very sensitive. We bought Pioneer Foods in South Africa earlier this year, and we just closed on that one. We also closed on Rockstar Energy for about $4 billion. So we've actually been taking advantage of the financing environment to go and buy attractive assets to make our portfolio even stronger.
Should we be prepared to see more of that in the year to come, Hugh?
Well, it's always hard to speculate on M&A, so we'll see what happens.